There's a lot of comments you'll hear when people talk about tax brackets that just might not be true. For example, have you ever heard someone say, I don't want to earn any more because I'm going to jump over a tax bracket, or I'm paying way extra tax this year because I jumped over a tax bracket? Let me explain how tax brackets actually work and why some of that might not be completely true. And I'm going to talk about one strategy that I've seen people implement in particular situations that's helped them save nearly $20,000 by just understanding the tax brackets. So let's start with the basics. How do tax brackets work and what are they? So your tax bracket will determine which rate of tax you're paying for those particular earnings. Now these are marginal tax rates, so let me bring them up. So we can see from 0 to 18,200, you're going to pay no tax on that income. And then from 18,200 to 45, we go up to 19 cents, and we progressively go up until we get to a 45-cent tax bracket. Now the way this works is you're only going to get taxed that tax bracket on that range of income. So if you're earning $30,000, your first 18,200 is going to be tax-free, and then the next section of that, which is going to be the next 11,800, is going to be taxed at 19 cents. Just because you're earning $30,000 doesn't mean your whole income is taxed at 19 cents. Only the part that has gone over that first bracket. Now, one thing to keep in mind is these do not include the Medicare levy, which is normally 2%. It's a whole nother topic, so I won't be talking about that today, but just keep that in mind when you're trying to do some calculations in your head. So what is this myth of people not wanting to earn over a tax bracket? Well, let's have a look at what we've just talked about. We know now that we have different rates depending on where our income falls, but that rate only applies to that income that's over the previous bracket. So we can now understand that if we earn an extra $1, we're just going to pay the higher rate at that dollar. So let's use an example where we've earned $1,000 more. So first of all, say we were earning $44,000, now we've earned $45,000. So that $1,000 will be taxed at 19 cents to the dollar, so we'd pay $190 tax on it. Now let's go and say earn $45,000 to $46,000. So we've earned that $1,000 extra. But now because we've gone from 45 to 46, we're at the higher tax bracket, we're at the 32.5 cents, so we're going to pay $325 extra. So those two different levels of $1,000 of earning, the tax has changed on that $1,000 because we've changed tax brackets. But all of the other income, all that income up to 45,000 is still going to be taxed the exact same way if you earn 45 or 46. It's just the income beyond the 45,000. So it doesn't matter if you go over these brackets, because all that's going to matter is you're going to pay a higher rate on that particular earnings, but you're still going to be ahead. In nearly all situations, there are some exceptions that I'm going to talk about soon, but the more you earn, the more income you're going to end up with after tax. That is because the highest tax rate we have here is 45 cents. So even if you're earning $1 there, you're still going to have 55 cents to you and 45 cents in tax. So don't listen to some of the myths that float around. Do your own research and understand how it's actually going to impact you. Now, I did say there are some odd situations where maybe you might earn less by earning an extra $1. The main one of these that impacts your tax return is going to be the Medicare levy surcharge. So I've done a full video talking about private health and the implications that has, and in particular talking about Medicare levy surcharge. But at a real basic level, if you earn over $93,000 as a single or $186,000 as a single for this 2024 year, this has gone up since the prior year, so just keep that in mind, and you don't have hospital private health, you will pay the Medicare levy surcharge. Now the Medicare levy surcharge is calculated on what they call your income for surcharge purposes. Go and check out how that is calculated, but in essence it's going to be a taxable income adding back a few extra things such as reportable fringe benefits and reportable super contributions. But this is going to be on your total income. So if we earned $93,000 exactly, we didn't have private health, we won't pay any Medicare levy surcharge. If we earn $1 over that, we've now earned $93,001, we're actually going to pay the surcharge, and that's going to be 1% on our total income, so $930.01. So this is a rare situation where earning $1 extra could actually put you in a worse position. Now this is obviously going to only apply if you're really close to these thresholds, so it is just something to keep in mind. Now there could be other things that do impact how much tax you're paying or how much total money you're getting, such as Centrelink, or maybe it's childcare subsidies, or maybe it's child support. So make sure you understand how those things impact you based on your total earnings, besides just the general tax that you'll pay through your tax return. Now before I get into the example where I'm going to explain how someone could potentially save $20,000, I really am aiming to get to 10,000 subscribers on this YouTube channel, and I'm getting close. We're at almost 9,500, so only just over 500 to go. So if you haven't already hit that subscribe button, it would mean the world to me. Now, let's get back into the video. In an ideal world, you would understand what your earnings are going to be year to year. And this is because balancing your earnings typically will work out better. Now, what I mean to this, and this is going to typically apply a lot for people that have businesses or maybe are selling investments and wanting to balance this out. Trying to balance your income from year to year will give you a great tax advantage because you're using up those lower rates in the lower tax brackets. So let's give the example here of someone that earns $120,000 a year, and they earn that across year 1 and year 2. And we're going to compare that to someone that earns $240,000 in year 1 and 0 in year 2. So the same earnings across the 2 years, just differently distributed. So let's look at this first person that earns $120,000 in each year. So they're going to pay $31,867 in tax, which is the tax plus the Medicare levy in each year. We're assuming they've got private health cover. So their total tax that they're going to pay across the 2 years is $63,734. Now let's compare the second person. So they earned $240,000 in year 1. So again, we're going to assume they've got hospital private health cover, and their total tax is going to be $83,467, including the Medicare levy. They're not going to pay any tax year 2 because they've got no taxable income for that year. So let's look at these two situations. Person 1 has paid $63,734 in tax. Person 2 has paid $83,467, which is $19,733 more in tax by having their income so unevenly distributed. So it's definitely something to keep in mind if you know where your future income is going to be at. It could impact some of your decision making, especially as we get towards the end of a financial year. Now, there are potentially new rates coming in from 1st of July 2024, so I'll quickly bring these up on the screen. But as you can see, we're going to move to less tax brackets, and it is going to actually help anyone that was earning between 45 and 200 grand. So we're still going to have the same rates for 0 to 45,000 split across the nil and the 19 cents. And then from 45 to 200 will now be one flat tax bracket of 30 cents, and then 200 over will be 45 cents. So this is definitely something to keep in mind. Keep an eye out when we get closer to budget night to see whether this does stay intact and applies from 1st of July 2024. Now, if you're looking to continue increasing your knowledge when it comes to tax, I've got this upcoming video which is all about individuals and how they can best manage their tax affairs and how they can get more out of their tax return. I hope to see you over there.